Good morning, you're watching Market Cafe on ET Now with me Shreyanti Singh and Snehisha, and over the next 1 hour we'll get you updates from within the country as well as across the globe. Also tell you what the Wall Street was up to last night, and Snehi, let's start with this fact.
Well, absolutely. Lots is happening when it comes to tariffs, and we are not surprised because that tariff tirade still continues to exist. And hi there, good morning. It's not only the tariff tirade that is there, it's the hangover of the uncertainty that comes with it. Because if you see, while our markets were off yesterday, the US markets were up in a buzz, or should I say down in a buzz, because that's the mood when it comes to the US market. And let's understand what has happened in Wall Street yesterday. Stock futures, if we address that and talk about that first, they have fallen largely this morning, and it's not looking very good for the US market right now, and it's looking rather bleak. Let's take a look at what has happened on the back of this entire trade war that's happened between US and China. Now, what we understand is that a White House official has confirmed that now the current rate of the tariff that US has applied on China is 145%. On the back of that, stock futures fell last night as investors look to close out a volatile week punctuated by sharp swings for the major averages. Tariff fears, of course, remain at the forefront of investors' minds after President Donald Trump temporarily slashed his country-specific duties to a universal rate of 10% except for China. So that pressure and that overhang still continues to be there. Goods from Beijing will see a rate of 145%, like I just told you. And on the back of this uncertainty, yesterday the S&P 500 fell almost 3.5%, while the 30 stock Dow tumbled more than 1,000 points, or 2.5%. You had Nasdaq also that ended the day lower by 4.3%, so that was the big loser yesterday. And Thursday's declines wiped a chunk of the gains the major averages saw on Wednesday after Trump announced a 90-day reprieve on some of his high reciprocal tariffs. Because remember, on Wednesday, the S&P 500 surged 9.5% for its third largest gain in a single day since World War II. So that's a huge jump coming in. So some would say that this was a correction that was waiting to happen on the back of a huge rally that the market has seen on Wednesday. It could be profit booking, but it was also a lot of it came from the tariff overhang that continues between US and China, while the rest of the world has been given a 90-day pause or a 90-day break from Trump's tariffs. Let's understand what the implication of this is, because stocks resumed their losing ways yesterday as traders went into risk-off mode with trade policy uncertainty weighing on sentiment. Despite the tumult this week, the three major averages are on pace for solid gains over the course of the period. The S&P 500 is on pace for a 3.8% advance for the week, its best weekly performance since November. Nasdaq is on track to gain 5.1% for the week. Dow is on pace to jump 3.3% jump week to date as well. So over the course of this tariff dilemma, or rather the tariff up and down that the market has seen because of that, still on a weekly basis, all three indices stand to gain. So at least that is looking good for Wall Street. Another thing that happened while we were away and Wall Street was working is the CPI numbers and the job expectations numbers. The jobless claims were in line with expectations. CPI has come in 20 bips below expectations, so that is also something that has done very well for Wall Street. But well, yes, amid all of this volatility, let's see what holds for Wall Street today and how that pans our market open this morning. But Shreyanti, let's talk about commodities as well, because lots has been happening with crude too.
Well, absolutely, lots just about sums it up, right? Because you've seen a little bit of a roller coaster week coming in as far as crude oil prices are concerned. Currently, when you take a look at the moves yesterday, crude oil futures fell more than 3%, and that was after President Donald Trump's steep tariffs coming in on China that overshadowed his 90-day pause on higher rates for most other countries. Now, when you take a look at price levels, then US crude oil fell just about $2 thereabout. 3.5% closed around those $60 per barrel levels, and the global benchmark Brent as well lost 3.5% thereabout, settled around those $63 per barrel levels as well. But Trump's decision to increase tariffs on China, the world's second largest economy and the biggest crude importer, was to an eye-watering 145%. That is something that weighed on the market. And that is largely the kind of picture that we have as far as crude is concerned. Other than that, in terms of the factors, you do have OPEC Plus also agreeing to accelerate output increases, and that's also something that we've been looking at very closely this entire week in terms of factors as far as crude is concerned. But moving on, let's take a look at gold prices, because on the flip side, you do have gold that jumped nearly 3% to end at around that all-time high, in fact, coming in for gold as well, as a drop in the dollar as well as an escalated trade war between the US and China drove investors towards the safe haven allure of the precious metal. So spot gold climbed nearly 2.5%, $3,000 per ounce plus levels is something that you're looking at as far as bullion is concerned after hitting that all-time record high earlier in the session. So that's largely the kind of picture that you have for gold. Other than safe haven demand, you do have central bank buying, but that's really taken a backseat because you do have safe haven demand that has been in the spotlight as far as gold is concerned. Other than that, of course, you do have the dollar index extending losses to a 6-month low. So lots to look at this week, and it's been quite the roller coaster week, Sneha.
Well, absolutely, a lot is happening, but let's keep it going with US and especially what's happening on the politics front over there, because the White House is firing back at Democrats, accusing them of playing partisan games over claims of possible insider trading tied to Trump's tariff pause. Markets surged after Trump announced a 90-day delay on steeper tariffs, prompting calls from Democrats like Senator Adam Schiff for an urgent inquiry. Trump's cryptic posts before the news, "Be cool, great time to buy," are now under scrutiny. The White House insists the president was simply reassuring markets, not tipping off any traders. Also remember that the tariffs on China now total over 145%, including the fentanyl tax that's also coming in. But when asked for his reaction to Wall Street's market sell-off, Trump said he hadn't seen it during a cabinet meeting. Prompted to weigh in, Besant added that as negotiations develop, the US will end up in a place of great certainty. Let's go across and listen in.
Mr. President, can you give us a reaction to today's stock market drop and also give us a sense of the next steps with China?
Well, I haven't seen it because I've been here for 2.5 hours, so I'll be seeing it. I think Scott went out. Scott, you want to have a statement on that?
Sure. Look, the up 2, down 1 is not a bad ratio, or up 10, down 5. And I think as we have talked about, as we go through the queue and settle with these countries who are going to bring us their best offers, we will end up in a place of great certainty over the next 90 days on tariffs. But we had very good inflation numbers today. Oil's down. We had a successful bond market, so I don't see anything unusual today.
Mr. Trade Representative, are you aware that the tariffs have been paused?
I am, yes.
When were you made aware of that?
Well, I understood the decision was made a few minutes ago. It's something
Sitting here,
under discussion.
Sitting here, under discussion. So did you know that this was under discussion, and why did you not include that as part of your opening remarks?
So typically what I don't do is divulge the contents of my discussions with
What are the
President
details of the
Congress.
pause?
Well, my understanding is that because so many countries have decided not to retaliate, we're going to have about 90 days.
No, excuse me? China increased their tariffs on the United States. Trump blinked.
What's the blink, sir?
What do you know about this pause? What are the details of it?
Well, the details, as I understand it, is that China continues to retaliate. Other countries didn't retaliate. The president 2 or 3 days ago said we wanted to negotiate with those countries that asked for meetings. That's what we're doing.
What are the
We've had
details?
discussions.
How long is the pause? How many days? How many weeks?
I understand it's 90 days. I haven't spoken to the president since I've
So
been
the
in this
trade
hearing.
representative hasn't spoken to the president of the United States about a global reordering of trade.
All right, then moving on, after a fresh market sell-off, Trump's top trade advisor, Peter Navarro, is brushing off panic and cracking jokes. In fact, in an interview, Navarro dismissed claims that Trump's tariff U-turn spooked global markets, saying it's just a normal retracement, no big deal. Despite a historic market surge earlier, volatility remains in focus as well. But moving on, let's take a look at elevated bond yields levels as well. We caught up with Andrew Ferris, who's the CEO at Ecognis Advisors, to decode the same. Let's go across and listen in to what he had to say.
China is the second biggest holder of both of government bonds and of treasury bills, following Japan. Should China decide to sell all or part of it, it could really deliver a colossal blow to the United States for 2 reasons. First, interest rates in the United States will go through the ceiling. Remember, bond yields on the 10-year went by about 40 basis points within few hours, 40 basis points. Okay, since then, they have not fully recovered at all. The idea that the bond market has recovered is just not true. Okay, so should the Chinese decide to sell part or all their holdings, they will force on the United States an enormous increase, possibly double the yields, if not on long-term yields, and that will make it impossible for the Fed to cut interest rates, which is what Trump wants. The second thing, of course, it will devastate the US dollar because the Chinese will sell, will receive US dollars, and then they will promptly dump them because they will want to switch the money into renminbi.
Okay, well, and trade talks are indeed picking up pace because US Trade Representative Scott Bessent met with Vietnam's Deputy Prime Minister Ho Duc Phoc to discuss unresolved economic issues. In a social media post, Bessent called for continued engagement and quick, demonstrable progress. The meeting signals Washington's intent to strengthen ties amid an intensifying trade war.
Rather than moving on, Trump is not ruling out an extension of his 90-day tariff pause. Speaking in a cabinet meeting, he in fact warned that if trade talks stall, higher reciprocal tariffs will snap back into place. It's got to be good for both parties, and that's the word coming in from the US president. But when pressed on whether he'd extend the pause, his response was, "We'll have to see what happens." So that really is what he's saying when it comes to this entire pause.
Well, the action continues because former Treasury Secretary Janet Yellen is the latest person slamming Trump's trade policies, calling them the worst self-inflicted wound I've ever seen. In her first interview since Trump returned to office, Yellen said the US has been hit by a huge protectionist shock and now faces the highest tariff rates since the 1930s. She added that she couldn't give the administration a passing grade if asked.
Rather than moving on, a new study shows that Trump's 25% auto tariffs could cost US automakers a jaw-dropping $108 billion this year. The Center for Automotive Research says that the Detroit, Ford, GM and Stellantis will take a $42 billion hit. Each imported car could carry nearly $9,000 in extra costs, while parts alone could add nearly $5,000 to US-built vehicles.
Well, we spoke about inflation earlier. Let's talk about it in greater detail now. US inflation has cooled off, dropping below 3% for the first time in 4 years. March CPI fell 0.1%, pulling the 12-month inflation rate down to just 2.4%. Gas prices have tumbled, eggs soared, and rent barely budged. Core inflation, which strips out food and energy, rose just 0.1%, its smallest gain in years. However, analysts warn that this is just the calm before the storm as tariffs kick in.
Rather than moving on, jobless claims in the US ticked up slightly but remain near historic lows. Initial claims rose by 4,000 to 223,000 in the first week of April, right in line with market expectations. More notably, in fact, you do have continuing claims that also fell by 43,000 to 1.85 million, signaling some improvement when it comes to re-employment. Meanwhile, claims by federal workers also dropped to their lowest under President Trump.
Well, on that note, we'll slip into a very short break as this is a roundup of all the important global stories and rather more US-focused and tariff stories that we wanted to bring to your table this morning. But on that note, we'll slip into a short break, and when we return, we'll take a look at how the Asian markets have opened up. So you stay tuned and we'll be right back.
Welcome back. Thank you so much for staying tuned in. Well, as promised, let's get your check going as far as the Asian markets are concerned. And of course, you did have, when you take a look at the Wall Street, you did have that biggest burst of buying coming in since 2008 after Trump blinked when it comes to tariffs, with that 90-day pause, giving some much needed respite for just a bit. The historic rally, of course, was reversed. And you do have similar moves coming in for Asian indices as well, because you do have Nikkei paired gains of over 9%, currently down about 5%, 4.5% on your screens as well. Kospi as well gave up all of its gains. It was up 6%, currently down 0.6%. So that's the kind of trade you have when it comes to Kospi as well. And ASX 200 down 1.6% there, about 1.5%. Hang Seng as well as Shanghai, let's take a look at those as well, because 0.8% decline for Hang Seng is what you have. As far as Shanghai is also concerned, a slight bit of a downtick is what you're seeing for Shanghai as well. pared some of those gains from earlier as well when it comes to even this particular market. So currently, that's the kind of picture that you have emerging for all of these Asian markets, because you do have that much needed respite that came in, and that was given up very quickly, because you did have them pairing all of those gains with all of those markets, no exceptions there. A shade of red is what you have. A sea of red, in fact, is what you have as far as the Asian screen is concerned. But back home, of course, you closed around the 22,400 levels. Currently, what is being penciled in is a gap up open. But with that sort of handover, let's really see how that pans out for us.
Well, absolutely, because a 500 point more than that, at least on the spot, is where we're expected to open. But like Shreyansi said, global cues are not that supportive. And while we're expected to open 2% higher today, we'll just have to wait and watch what this last trading session of the week holds for us, given how weak the global cues have been. But hi there, welcome back to Market Cafe. Thanks so much for staying tuned to us. You're still watching ET Now. Let's take a look at some of the biggest updates that came in yesterday, because even though our markets were closed, it was a trading holiday. We have kickstarted the Q4 FY25 earnings season, and IT Bell, where the TCS, as always, has kickstarted it this quarter as well, because Tata Group tech giant TCS has reported a subdued Q4 with net profit and margins below estimates. As the company crossed $30 billion revenue milestone, the board approved a final dividend of 30 rupees per share. The company won deals worth $12.2 billion during the quarter. Let's take it across to my colleague Ankur to get all the details.
Yes, TCS has announced a revenue of 64,479 crore, which is up 5% YOY in constant currency terms. The uptick is 2.5%. But the important thing is here the operating margins stood at 24.2%. There is a slight dip quarter on quarter, and net margins remained at 19%. But the highlighting part of the earnings has been TCV, which stood at $12.2 billion. Last quarter it was around $10 billion, so there is an uptick there. But more importantly, book to bill ratio has risen to 1.6%, which is a key metrics to watch out how actually the order wins are, how deal pipeline is. Apart from that, the company has also proposed a final dividend of 30 rupees per share. Now this will be approved in the AGM, but all in all, the company remains watchful of the global scenarios, of the macro conditions, what is happening in US. But having said that, the aspiration of growth remains. The expectation is that FY26 will be better than FY25.
It was a completely miss on all fronts, largely because mainly a slowdown in the ramp-ups because of the macroeconomic uncertainties going around, and not only just because it was a macroeconomic concern in terms of inflationary, but definitely, and I mean there are some economic conditions are not only in favor of the IT spends or discretionary spends, I would say. The pickup is likely to be delayed at least for the couple of quarters, and visibility is not there. That we have also been make out from the Accenture results as well. But yes, definitely North American side and the European side is likely to be weaker in terms of IT spends. One might get a pickup in the second half of the financial year. Deal wins that they have, the order book that they have is impressive, but it is not ramping up is not really happening as of now. And we believe that there will be a lot of uncertainties going around.
All right, then on that note, let's also go across and listen into what the management then had to say when it comes to not just the impact of tariffs, but also deal wins as well as their margin guidance when it comes to financial year 26.
The uncertainty crept in. Some industries, you also saw the US consumer confidence index going down. So the impacted businesses tend to be in the consumer retail sector. Retail has been impacted to some extent, and when I say retail, CPG, and also travel, hospitality, that's probably the most impacted sector. And another sector that's been impacted is auto, like because of the tariffs that have been imposed on the auto sector. deal long-term commitment from our customers. One way to look at it is what is the length of duration of the deals. As you mentioned, the deal duration hasn't changed, and as you mentioned, the TCV that we signed this quarter, even without any mega deals, is probably the second highest for us, right? It's a 12.2 billion. The previous high had a significant portion of mega deals in it. So we are not seeing any reduction or reduced commitment from our customer. In fact, the engagements are only stronger.
FY26, absolutely. So first, our overall guidance range, or the guidance beacon which we call it, still remains at 26 to 28%. There is a gap, and given the current environment, there might be some impact on the operating leverage, maybe because of utilization taking a impact. In the short term, would there be a margin impact? There won't be, because one, the investments which are being done are already carrying on. Second, in terms of directly linked to the productivity question, it is about sharing gains which are realized. So there also, there won't be any.
Okay, well, let's move on from TCS and talk about the RBI. They've published a draft regulatory framework for lending against gold. The move comes shortly after the central bank decided to cut the repo rate, signaling a broader effort to fine-tune credit practices and consumer protection. Varun is here on the phone line with more details for this. Varun, good morning. Take it away.
Well, so RBI has come out with a new draft for gold loan financing, and it's just a draft, not the final guidelines. And this can be bifurcated into 6 parts. Among the most important is the LTV. The LTV definition has been tightened more for NBFCs rather than banks, although the LTV remains unchanged at 75%. But for banks, the LTV is capped at 75% only for consumption loans. For NBFC, the cap is on both consumption and income generation loans, and the LTV of 75% or less will need to be maintained to the life of the loan, following which there will be a penalty. The LTV on gold loan consumption, the bullet loans, will need to be incorporate the interest accrued, which is new for both banks and NBFCs. So there are some of the rules which have been tightened for NBFCs rather than banks. Also for loan bifurcation, the income generation loans. I mean, if you take a gold loan for farm business or any other business, that needs to be shown not as a gold loan, and it has to be classified as a business use. So this is one thing that RBI has said in the draft, and the onus of classification actually comes from the lenders. It is on the lender to classify these loans. Also for the loan renewable, the gold loans which are performing well, they can be topped or provided that the interest is accrued and cleared before the rollover. So there you can do the top-ups. So if you look at the overall draft circular, there is it is more slightly negative for growth. That is what brokerages are saying, and this will impact the loan growth for NBFCs more than banks. And if you look at Nuvama says that Muthoot Finance is one of the companies that could be impacted, whereas Nirmal Bang says that if the circular is implemented, this will impact the loan growth of some of the banks and smaller NBFCs. We don't have adequate policies and procedures in place for gold lending. So these are the two companies which you need to look on after this draft regulation. But this is only a draft, and let's see what the final outcome of this draft comes on for the gold loan financing.
Well, absolutely, Varun. We'll wait by for the final outcome. But with that, it's time for a very quick breather on the show. When we come back, more news and updates on the other side, so don't go anywhere. Welcome back. Thank you so much for staying tuned in. Well, it's time now to get to the futures and options roundup. In fact, Ansh is standing by with just that. Ansh, over to you.
Well, let's start with Nifty first. In the previous session, Nifty closed within its previous session range only, and it has been consolidating within that Monday's gap down of that 22,850 to 20,250 mark. But today, GIFT Nifty is indicating very positive opening, so we may see this consolidation breaking on upside. On option front, we are seeing some mild call writing happening at a 22,500 mark, indicating some resistance around this level. At the same level, we are seeing some put writing as well. Whereas for Nifty Bank actually traded below that previous consolidation range of that 50,800, and it has been consolidating there only from last 3 sessions. And today we may see Nifty Bank entering back into this range. Whereas on future front, we are seeing open interest going down by around almost 1%, indicating mild long unwinding. Now, if you talk about index future, then in previous session, FI have actually reduced their longs by around 7,400 contract. At the same time, they have reduced their short as well, but net to net basis, they have reduced the contract by 6,700, due to which the total long position has slipped lower below 22% to 21.6%. But at the same time, retail traders have actually added longs by around more than 9,000 contract. They have added some short as well, but net to net basis, they have added around 7,900 contract, due to which the total long position has inched higher from 57.2% directly to 58.5%, indicating very strong bullish pressure from retail side.
Priyansh, thanks for taking us through all of those levels to watch out for in today's trading session. But time to revisit an expert voice coming in amid the market that we're seeing right now. Higher earnings growth needn't lead to higher returns, says 3P Investment Managers Prashant Jain. He also shares his outlook on various sectors. Let's go across and listen in.
Is that higher earnings growth need not lead to higher returns, as we have seen time and again. If you go back 5 years, utilities were deeply undervalued. What has been the earnings growth? Very low, below market probably. But returns have been extremely high. Similarly, you have sectors, let's say some companies in consumer, which have grown earnings ahead of markets, but the stocks have not done well. So I think as long as you don't extrapolate earnings growth to stock market returns, it is okay. So I feel one, the dispersion in earnings in this market is going to be extremely low because the most sectors are making reasonable margins. Still, I feel banks, insurance companies, they should grow earnings maybe slightly ahead of markets. Telecom could grow earnings slightly ahead of markets. Even capital spending, I think, will grow ahead of GDP. The IT, the near-term outlook is mixed. In pharmaceuticals, it is more individual company-led. In consumer, I think mid to high single-digit earnings growth should happen. In automobiles, I think there will be greater volatility year to year because it's an asset which people buy and demand tends to vary year to year. But longer term, I think even automobiles should grow in line with the aggregate earnings in here. Yes.
Now let's look at a pocket where you think the earnings growth will not be there. You think either it's going to be lower or it will get much more lower going forward.
See, in commodities, for example, if metal prices fall, if oil prices fall, earnings could obviously get impacted. But I think markets appreciate that aspect of this sector. But I would say, in cement, if prices go down, you may not have earnings growth. In automobiles, if in a particular quarter or a particular year, demand is weaker, you may not get earnings growth. You may actually even get a degrowth because if volumes are not there. So I think there could be some pockets where earnings growth is not there, but overall, I think we are quite well placed.
Okay. Prashant Jain believes in one thing: buy cheap, sasta, sundar, tikau. What is cheap in this market? Where is value in the market?
So, fortunately or unfortunately, there is, to my mind, no outlier value in this market. And we have been saying that for a long time. There are sectors like consumer or small mid caps, which I think are still meaningfully expensive. And over time, they should correct. This is my opinion. But if you start looking for deep value, I don't think there is deep value in this market anywhere. The dispersion in valuations. So we did an exercise. We said, let's look at 15-year average valuations because 15-year captures roughly 2 cycles and compare the current multiples relative to that. So there is no sector which is trading at a discount to 15-year multiples. And the premiums are also confined to just 2 sectors. I think it is capital goods and consumer discretionary. I think this is a market where it would make sense to run a fairly diversified portfolio because dispersion in valuations is actually quite low.
I like to shift attention to something very specific, which is utilities. And you've gone on record that you liked power stocks in the past. And everyone knows that this time गर्मी ज़्यादा पड़ेगी. गर्मी ज़्यादा, AC ज़्यादा, बिजली की demand ज़्यादा. Should one now start taking, should one start looking at some of the utilities and some of the so-called power and these safe stocks now, because interest rates will come down, demand will be high, and in this volatile environment, power पे तो tariff नहीं आने वाला.
Nitin, you are right that this sector presents growth opportunities to India. And it's, as I said, our AC penetration is hardly maybe 4-5%. So our per capita power consumption is a fraction of the world. So as incomes grow, power demand in India should continue to grow. Now the key is how are you? So growth outlook is fairly steady. It is moderate, but it is fairly steady. It is de-risked. But the key is what are you paying for that? So there, I think the variation in valuations across utilities is quite high. So I think it is mainly a bottom-up approach that one will have to adopt in this sector. I don't think this sector is as cheap as it was 3, 4, 5 years back when it was impacted by either the some tariffs were cut in COVID, which impacted these companies, or because PSUs were out of favor, or because of the ESG challenges. So I think these stocks, again, to my mind, are reasonably valued, and one should expect uh, close to market or maybe slightly ahead returns, but it would be more stock specific.
Then time now to help you start your day right, get some more commentary coming in. Then Vikas Khimani, founder Carnelian Asset Management, discusses the impact of Trump's tariffs, also says that the Indian economy remains insulated relative to other countries, and lists out the sectors that he's bullish on, also believes that June onwards, market stability should return. Let's go across and listen in.
India is on a relative basis quite well placed, and that can give us comfort. And eventually, I think it will settle down in next couple of months. And once I think the dust settles, I am sure India will definitely emerge a winner or a better player or better placed than what it is today. So that's at least confidence I have. Now, as far the from bottom or how much it can correct more, nobody knows. But I would like to believe that market should bottom out in around 22,000 levels of Nifty. Which is where we are. I think give and take 300, 500 points. These days swings very often, so can't say that. But I think from a fundamental perspective, valuation perspective, it's a good range of 17, 18 times earning. India macro from all standpoint of view is very, very solid. There's no fault line. There's no major risk.
Prices will bottom out before events do. What is the right way of understanding that this is the price bottom? It may not be the news bottom.
So I think again, that, from a short-term perspective, nobody can say that market in short-term market can be very, very irrational. For one news, we saw how markets reacted, on a particular day, and I think India stood again very, firm within that construct. But markets can go. But another comfort one can take is that we are in a good growth environment as far as Indian equities are concerned, economy is concerned. And at 17, 18 times price to earning, Indian Nifty does not look at all expensive. It is very, very good proposition. And like we have discussed many times, nothing on the Indian story changes. Given this current tariff situation continues, India tariffs lowest being only stands out as an edge for India rather than a risk for India. So Indian producers will be far better placed in terms of exporting to US than anybody else. And if that's the case, then the worry should not be there. It should be seen more as a comfort. But whenever there's a fearful environment global level, it is rightfully that markets can be edgy. And that's the reason I believe that I don't see deep downside from here unless some, again, catastrophic event happens, globally. It's very hard. My sense is that we are in and around 500 point plus minus from here. We should be in this range. And as the earnings come out, as the issue settles down, we should resume our trajectory. My sense is that in this quarter, April, May, June quarter, all these things should settle down, and June onwards we should look good.
Because one side, interest rates are likely to go down. India, they've already gone down. Globally also, they will go down. Second side, there is fear of inflation because rates will go higher. What is the right way to look at it? Inflation coming back or interest rates going down and the impact of it?
So I think it's a very interesting question, Nikunj, you ask. I think in US, at least what I understand, that's how it's being planned. That there's a lot of cut in the expenditure which is happening through Doge, and tariff will probably give some tax collections. So net, I think President Trump probably trying to bring down the fiscal deficit, which will pave the way for aggressive interest rate cut, and which will eventually pave the way for investment cycle. This is the probably path President Trump is seeking. The problem with this path is that there is a lot more pain before it starts getting the gain, right? So this journey for US, in my opinion, will be painful. US could be facing an inflationary issue if they go ahead with this kind of tariffs, because it's very simple calculation. It's not a big deal you need, but so I'm sure that they will have to figure out whether how much inflation happens. Nobody knows. Again, like I said, if you don't know what the outcome, what the policy is going to be, how will you know the inflation output? But at the same time, as far as India is concerned, I think we are in a reasonably good environment. In fact, if the commodity prices remain soft, it helps India. I think India is not in a very mega inflationary environment. We are in a reasonably well managed inflation environment over the last many years, including during the Ukraine war time. So I think India has a lot of scope for further monetary policy action.
Okay, well, that's the word coming in from Vikas Khemani, but time to focus outside of the markets and take a look at everything else that's been happening. In the tragic incident, a sightseeing helicopter carrying 6 people crashed into the Hudson River on Thursday afternoon, killing everyone on board and prompting a major water rescue operation. The chopper, operated by New York Helicopter Tours, had departed around 3 p.m. from a downtown helipad and was flying north over the Hudson. And while shifting focus, Italian Deputy PM will be on the 2-day visit to India from today. He is set to meet External Affairs Minister S. Jaishankar. He will also meet Union Commerce Minister Piyush Goyal, while to enhance collaboration in key sectors like agriculture, defence, space, infrastructure and transport. India and Italy held discussions in New Delhi earlier in February as well. Well, PM Modi is set to visit Varanasi today, where he will launch several projects. He will also address a public meeting there. This will be his 50th visit to Varanasi since he became PM in 2014.
Alright, then moving on, a Delhi court has sent the Mumbai terror attack mastermind, the Habur Hussain Rana, to 18-day NIA custody hours after he was extradited from the US. He has been arrested under the stringent UAPA Act. Moving on, then, Chennai Super Kings will take on Kolkata Knight Riders today in the 25th match of IPL. MS Dhoni will captain CSK in place of Rituraj Gaikwad as well. CSK have had a tough start to the season, winning just one of their first 5 matches. But with that, completely out of time on this edition of Market Cafe on ET Now. Thank you so much for tuning in.
If you like this video, then like, share and subscribe to ET Now.